View it later.
Hello, Dale.
Hi, Greg. It's so nice to meet you. Thank you for spending your most precious currency, which is time. I say
Huh,
that pips come and go, time's gone forever. That's
right.
our most precious currency. You and I have spent quite a bit of time in this industry. Your reputation precedes you. Even a quote that non-trending markets evolve into trending markets and vice versa. That's a Greg Michalowski quotation, is it not?
Yes, thank you very much. It's my honor to be here, and I like to think that over my career, I've been able to learn from a lot of people, and this is a time for me to give back. So, giving back of my time to others, including yourself, and to retail traders in particular, is what I'm about right
Yeah, well,
now.
that's a great point. Pay it forward, but
Yep.
let's put it in reverse. Who were those people at
Yeah.
the beginning of your career? How did it start, and who influenced you?
All right. First off, how did it start?
Yeah, who can you blame?
Yeah. From day one in my life. How about my father?
Okay,
My father was involved in Wall Street for his entire career. Worked at, Chase was his claim to, or his biggest bank that he had worked at. And he worked at the Federal Reserve
wow.
early on, the New York Fed,
Wow.
and this is way back when interest rates just stayed the same for a long while. But and then Volcker came along and rates started to move along, and I remember as a kid, when they used to have the money supply coming out
Yes.
on Friday. Dad wouldn't show up at the normal time on Friday evenings after work. It was a little later because that money supply number came out late on Friday, and depending upon how it was the number of the day of the week,
Yeah,
and
I remember.
and
Boy,
yeah,
you're taking me back to the tar pits. But
sure,
yeah, I
sure.
remember that, Greg. In fact, I remember one weekend over Memorial Day. I was short euro dollars, not euro currency futures, the 90-day
Hmm.
instrument. And
Right.
I got home and I heard Ron Insana right after the money supply saying that the Fed was going to lower rates, and
Hmm.
ruined my whole birthday weekend.
Yeah, it's funny how you remember those times of your life there. And usually the losses. So it's my father I blame. Blame. I remember Dale when he used to. I was one of seven, so we had the basement, and
Right.
and that was the playroom, and we had the ping pong table, and my dad was an early technician as well, and he used to get the charts mailed to him weekly. You probably
What?
remember. Yeah.
Commodity perspective?
Right. Yeah.
Okay,
Yeah.
yeah.
And he used to tape them together, and people would make fun of them, and those moon charts that you're looking at,
Right.
and what are you doing, Joe? And but he used to tape them on the ping pong table, so he dispersed all seven of us kids and took over the ping pong table,
What
and
a great
and
story.
yeah, it's my dad. It was my dad who got me involved in the
Well, you know
market.
what, Greg? Better than the internet, which wasn't around then, or just some hypester saying how you can find a path to easy riches.
Right, that's the truth. That's for sure. And so after college, well, actually during college, I had one of my other first mentors. His name was Bill Kidder. It wasn't part of Kidder Peabody, but Bill was one of the big early mavericks in the bond market, and he was on, for instance, he was on the cover of Barron's magazine, or Barron's, and they did the interview with him on the front cover at one point. But he went off and he started a software company that was designed toward arbitrage arbitraging interest rates and financial futures and interest rate derivatives and such. And he was one of the pioneers in that field, and taking advantage of the seed. You talked about the Eurodollar futures market. They had the the 90-day CD, and you'd lend 6 months and borrow 3 months and do the futures on the back end, and you'd arbitrage it because the futures were mispriced and stuff. So he started, when technology. This is going back to like 1980, 81 or so. Technology was developed. In fact, they used the Apple II at that time, and so and his math, his ability to do algebra basically, and these new products called futures and other derivatives, that off-balance sheet derivatives that you could use. He started to put those pieces together and develop really take the arbitrage out of the arbitrage by being able to access those programs. So that's where so he was another mentor of mine early on. I was really fortunate, and you know what you talk about paying back. Bill always said that Joe Mike was my mentor, and so you can come here, you could call around computers, you can go around things, or you can work on the programs and do stuff, whatever you want. But I'm going to give you a lesson. I'm going to give back to what Joe Mike, that was my dad, gave to me. And so maybe that little piece kind of sticks with me as well at this point in my life as well.
Yeah. So definitely. Your father mentored him, and
right.
he mentored you. What a great path! Your guardian angel is looking out for you, and now it's your turn.
Right. Yeah. So then that parlayed into because one of my customers was Citibank, and I moved and they were looking to utilize. They were looking to decrease the funding of their loan portfolio. Obviously, we're not talking about Forex here, but we're talking a lot about interest rates. But that was my first half of my career, was more into the interest rate field. But Citibank was looking for a junior trader to come in and utilize off-balance sheet products, and I knew what I was doing because I worked for Bill. So and he taught me all this stuff. So I left Bill with his blessing, and went off to Citibank and spent 10 years at Citibank in New York and London, working in the funding area, and then started to quote and run a book in off-balance sheet derivatives, including forward rate agreements and interest rate swaps, and at that point, other mentors included a guy who was the treasurer in New York. His name was Tom Burke, and he taught me to be prepared. Dale, yeah. At one time we used to have morning meetings, and we come into the meetings, and a lot of times you're a little sleepy, a little groggy, you have your coffee, and I was young, and I was feeling maybe a little bit. Got a little bit over my skis, and he started quizzing me, and I didn't know the answers, Dale. I wasn't prepared, and you always want to be prepared, right, in whatever you do, and in trading as well. You want to be prepared. You want to know where you're going in the trade. You want to know where your risk is. You want to know your targets are, and whether or not you get through those targets. It just doesn't start with the trade. It continues on through the momentum, and that's about being prepared. And that's the lesson that Tom Bergen taught me that day, which I remember. Like you remember your birthday when the money supply came out. I remember that day when Tom Bergen dressed me down in front of everybody there, and I vowed I would be prepared for the rest of my life.
What has been the most difficult thing to master? In my case, I'm much better on the entries and lack the patience quite a bit to ride to targets. To me, riding a trade is more difficult than entering a trade and managing the risk of the trade.
I would agree. I would agree with that, Dale. We all know about the fear of failure, and that comes when you enter the trade that you're going to fail on the trade, and then you have your fear of success. I call,
Interesting.
and that's when the market goes your way, but you fear that the market's going to take it away.
Right.
So, when I started to get my arms wrapped, I agree with you. That managing the trade and staying on the trend. You mentioned that idea that non-trending turns into trending, or non-trending markets transition to trending markets, and that is a way for me to get my mind wrapped around the idea that maybe it's time for me to invest in this position because the market's been non-trending for an extended period of time. Two moving averages coming together, whatever tools that I might use, and basically moving averages and trend lines, and you can just see the market's
So is
non-trending.
that
That's what.
indicative of a long phase of base building accumulation for, the turning into
Mhm.
what they say that bull markets top in violence and bear
Mhm.
markets bottom in silence?
Right. Yeah. 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 It could
So
be
you
that
have that
case.
compression building up when you have a non-trending market,
Right.
and then eventually it resolves itself. And since you've gone through the frustration of trading something that isn't
Hmm.
trending, when it finally the bell rings, you learn how to marry it.
Yeah. You invest in you invest in your position, and when I say invest in your position, um, think of we know that markets. Let's say the markets is bottoming and it's moving to the upside. If the market's non-trending, that's a different situation. Just when the market's, let's say, in a trend. So when the market's non-trending, it starts to break out to the upside. There's going to be those traders out there who are used to the market non-trending. This used to be me in the old days, and maybe you as well. Where if the, well, we've been in this narrow range, you get used to the ranges and it gets up to the top, maybe it moves a little bit above it, and people get used to selling high and buying low
Right.
and doing it and trading that little range, and thinking that they're God's gift to trading, when in fact they're just getting set up for that big trend type move. So you have to, if you have the mindset that the market is about to trend, or you're anticipating that the market is going to trend because it's non-trending, you have to invest some of your profit in when those little corrections come, when those other traders out there who are so happy to take 10 pips of, because they've been selling high and buying low over the last 8 trading days, unbeknownst that it's about to just take off
Hmm.
to the upside. Those traders come in and force the market to the downside. I equate it to like a restaurant that opens up. You can be doing well, and then you have to then you get to like the Thursday night, and you're like, well, should I have entertainment come in and play some music, and maybe get those diners to stay around for an extra drink or something? That costs you money to keep them. It's for that entertainment, but it's an investment in your business, and all
Oh.
businesses invest back into their business. And in trading, it's no different. You got to invest some profit in those little corrections that come, and measure those corrections. As long as the corrections hold up okay, as long as they hold up okay, then that you can anticipate that the trend is going to continue on. So I would agree that's the hardest thing, because it's easier to sit there and say, okay, I have no position. Here's the support, here's the resistance. Now I got to stay with it. And if you can learn to stay with it the longer, and catch those trends and attack those trends, like the title of my book, then you're on your way to the next
What is
level.
the title of your book, Greg?
Attacking currency trends.
Okay.
So,
Where can our listeners pick up a copy of it?
on Amazon.com, and or on my website, which is www.attackingcurrencytrends.com.
Thank you.
And if you use the promo code PROMO, PROMO, you can get the book there at $32. It's probably it hangs around 38 to 40 or something on Amazon. So,
Okay.
and I'll sign it. I'll sign it for you
Wow.
as well.
8x10 glossy too. I wanted to ask.
I used to have uh, uh, mouse pads. In fact, I have one here, and I should make up some more of them. But it had all my little sayings on them, like to make the most money with the least amount of risk, and
Right.
that idea, remembered lines and pennants and all that other stuff.
Let me
It's
ask you
kind of
this, Greg. What were you doing during the financial crisis?
which one?
Not 2000. Call it the Great Recession that we're still
2008 or
trying to
whatever.
come out of.
Yeah, for the last 13 years, I've been with FXDD and giving out, working with FXDD. I was there since day one, so I initially did the website, just an interesting fact
Wow.
for our firm and stuff like that. I mean, it was. It was back in the early days of retail
Yeah,
foreign
so
exchange,
you were a pioneer at FXDD.
that's right. Yeah. So, during the whole crisis, I was doing pretty much what I do now. Trader education and webinars and seminars and writing getting ready to help out the retail traders. So as a currency analyst for FXDD. So
Yeah.
so
You want to share your
that
screen so we could take a look at
sure.
your chart setups and some of the things that are important
Sure.
to you when you're looking at charts.
Sure.
Here it comes.
So
Here-
oh,
there you go.
okay.
There's a risk disclaimer.
Oh yeah, let me speak to
Yeah,
that
go ahead.
first, if I could just
Sure.
to be compliant. But trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and risk tolerance. I must say that for regulation purposes,
Well, it's
of
true.
course.
There are a lot of
Yeah.
unsuitable people out there that are risking money that they can't afford to lose, and trading with emotional capital it's tough enough when it's excess capital that's not going to affect your lifestyle. There's a lot of hype on the internet. Greg, trade for a living with a $10,000 account.
Mhm.
I don't know where you'd live besides a tent under a underpass. So,
Abs-
so
Absolutely, and this is for educational purposes
right.
only understand that, but so
You're
without
a lot of trend
all that.
lines, speed lines in here.
Well, I use three tools, Dale. I use Fibonacci retracements. I use trend lines, and I use two moving averages. I use 100 and the 200 bar moving average in my charts, and those are the three tools that I use. I don't use I don't have a filters like RSIs or and stochastics, because there's a reason for that. I won't necessarily go into it, but the tools that I use, well, and you can ask and I'll tell you why. But the tools that I use, the most important tools that I've found that are good for traders is tools that define risk and limit risk, and I call them border lines. They're trend lines, but they're border lines. It's like New Jersey on one side and New York on the other side. On the other side.
Great metaphor.
Yeah. Well, that goes back to my childhood as well. Going in the station wagon to New York, and we'd go through the Lincoln Tunnel, and there was New York and New Jersey, and we'd all seven of us kids piled in the car. God bless my mother and father. But we used to get to that borderline, and it was a visual that New York, New Jersey, and this is New York and New Jersey.
Yeah.
This is the borderline between New York and New Jersey. So we got halfway through
Was
the tunnel.
New York the promised land to you when you were a kid, and you crossed that threshold, or what?
It was. Yes, it was. Growing up in New Jersey, it was getting into New York and going to see the show or the Christmas tree lights, and later on in life, getting into Wall Street. What a thrill it was to take the train and go into the World Trade Center,
Yeah.
it was a thrill.
Were you ever driven to want to trade from the floor?
Mm-hmm.
Did you ever try it?
You know, no, no. Well, way back when the New York Stock Exchange had a futures contract or
The
whatever,
knife?
that
You
they had
mean
like
the
a,
knife?
yeah, the knife,
Yeah.
yeah, yeah. I went down to the seminar on the floor, and you know, they're like, "Go ahead, now trade," and it was the most confusing thing that I've ever done in my life. I mean, it was. I don't know how they do it in the floor of the exchange, but
You know what? I
but
did it.
oh
I
yeah,
learned off the floor, and I came back to the CME with an
uh huh,
IOM seat, and just like you, I found myself eventually just handing off an order to a
right,
local and having him fill it,
right,
hold my stop, and I'd go back upstairs.
right, yes,
Too
yeah.
noisy for me.
I know it doesn't didn't work for me either, but so those are my three tools that I use, and you know, it may look, you know, there are some other lines in here. These are basically overlays of from other charts, and the way that I look at the market, Dale, is that I consider that there are three types of traders. There are shorter term traders, there are intermediate term traders, there are longer term traders, and I want to get in their range. I want to see what see why this level is so important. So even if I'm a day trader or someone out there is a day trader, they never take a position overnight. They need to know what the weekly guy, what the longer term guy is looking at, because this
Great
level
point.
right here was a very important level. I don't care, you know, if you can do your homework and be prepared, like Tom Bergen taught me,
Right.
you know, you have to and make yourself a better, you know, hopefully a better trader. You have to know, even if you're day trading, that the market's moving up here and it's racing to the upside on your 5 minute chart, because you know we're going to the upside here, and you have to know that this level is
We
important.
had that line drawn off the as well for. I looked at it as a three drive to the
Hmm.
top formation, which I
Hmm.
learned from a guy named J.R. Hill in the 70s.
Hmm.
You
Hmm.
remember that name?
Yeah. 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 Yep.
Okay, so even though we traded up to that line and we've come off a bit, we're still in New York, not New Jersey, right?
Right. Yes. Yes. Yes.
Okay.
Exactly. You know. So if you're a shorter term trader, an intermediate term trader, a longer term trader, you know, scan through different chart time periods, because you'll start to put the odds a little bit more in your favor by knowing that that level exists. Or putting it another way, and this is most important, is that I don't necessarily focus on the reward, Dale. I'm more focused on what I'm gonna lose or potentially lose on a trade. And so these borderline levels become levels that you can define your risk and limit your risk. And the third step is accepting your risk. That's where you get your mindset set that I can lose this amount of money. So you define your risk and limit your risk, like any business. Any business out there defines their risk. The restaurant owner who has a guitar player, he defines his risk, he limits his risk, and then he accepts it and goes for it. Doesn't necessarily mean that if just because I sell at this level here, it's not going to go flying through here, and I'm going to lose the money around this borderline level.
Right.
I accept losses. You should accept losses. Everyone accept losses. We all are going to lose. You know, 50% of the time, if not more. More.
How
It's
about the psychological aspect to saying, well, I hope I'm not, instead of saying, I hope I'm not wrong, I'll put my stop there,
mhm.
having the attitude that, okay, Mr. Market, I've made my bed, I challenge you to prove me wrong.
Yeah, yeah, yeah. You know, I mean, that is the point of accepting. You know, when you define your risk and limit your risk, and you accept your risk, you are challenging the market to prove you wrong. That's the, you know, and you're going to, you know, you're going to say, go ahead, take it above that level, and if it goes above that level, you know what, I might join you on the long side, because that's a big break to the upside there. That is a key level there. So these borderline levels become where you want to trade. That's where the energy
That's a
is.
great point.
It.
So it's not only accepting the risk, but one of the
Mm-hmm.
most difficult things to do is if
Mm-hmm.
you're wrong, but the
Mm-hmm.
market's giving you another signal that negates why you got in a trade.
Mm-hmm.
Professional traders can reverse, can't they?
Right.
Hard
I
to
have. I
do.
have. It is hard to do, and that's another step. You know, staying on the trend or managing the trade and managing the targets and all that other stuff, and like we talked about earlier, that's difficult, and reversing and going the other way is also very difficult. A lot of times, what you can do is maybe not sit there and reverse, but watch the break above, and this doesn't matter if it's a weekly chart, if it's 5-minute chart, they all look the same, they all do the same thing. Traders want to trade against risk, but if it goes above and then look for the correction down to hold that level and then get in on it, it just becomes another borderline level, and maybe you don't reverse right away, but you look for that correction. At the very least, it changes your bias from selling here to bullish up here. I'm just concerned, and I think all traders should just be concerned about what is the bias, what is the most recent bias, what is the bias today, what is the bias in this minute right now, where who's winning,
Right,
who's in control,
who's in control.
Who's in control? So when I look at the weekly chart, I understand that level. I also understand, what's in play here. This trend line right here, I'm sure you have this trend line is here, going back to 2008, 2011 high. We came up to that level here in December.
Yeah, everyone had that line, and every short was taken out.
Right. So the shorts get taken out, and where are we going? We're going to this target. What do we need to do? Get above this target. If we can't get above this target, what are we going to do? Go back down. What are we going to do if we break this line? We're going to go down. And so you get your key levels, your levels in play off the weekly chart. Then you go to the day.
There's a perfect example of you had a breakout. If you were bearish before, you had to flip. But some of the best trades are breakout failures, aren't they? And isn't that what we have happening right now?
Absolutely. It moved above this trend line right here, which is going back 2008, 2011. We moved above it. Now we're coming down below it, and this level comes in at 138.02 in trading. This week, 138.02 is the underside of that trend line.
Okay.
And let's see, if I go to the 138.02 level here in this week's trading, this is the hourly chart right here. And note here how the market came down to the 02 level. It bounced. Where do we go? The 100-hour moving average right here, and then it moved through the momentum to the downside. This is the failure. We break through this trend line right here. We see this failure go down. We even take. We come down to this low here, and the market's been just
while we're on this short term, and this is I'm being mentored by you. You're clarifying some things for me.
Okay.
The whippy action that we saw, that big spike up, and then no follow through at 38.80 or so, and then the spike down to clear out the stops. I believe that the algos know where the stops are. They're above and below obvious swing points. What do you think? Many have commented on it that HFT and algos are making it much more difficult to trade successfully. What do you think?
Well, I wouldn't totally disagree with that, but I don't totally agree with that. And what I mean by that is that we all have a choice, we all have our levels, and we have to be prepared for the little moves above the 200-hour moving average here, where it goes above that level and comes whipping right down. So they know that the stops are here, and they trigger them, and then they're the ones selling through here, or they're the ones selling through here, and it goes down. But remember, as a trader, you have to. If we break through a level here, this is my if-should rule. If the market breaks through the 200-hour moving average, it should go higher. If it doesn't, get out, or look to go the other way. So it's a simple if it does this, it should do that. If it doesn't, get out. So the if-should rules should make you aware that if we break through this trend line right here and come down, we need to get through this. We should go lower. And now you go to the targets. Where should we go lower to, Dale? Okay. And this is where you get, we got to get through this low right here, because this market was flying to the downside here. We just flew to the upside here, and now we're flying to the downside here. If we can't get through this low and we move back above here, if you sold right here and it goes back above this level, you better watch out. you better not cry,
Yeah.
because and so that's the loss on your books. Those are the losses that you're happy to take because it goes whipping to the upside, and you save yourself. There's there are little nuances in trading that you have to listen to. One of the things, and kind of understand that comes with experience as well as you know. But the markets can get over. Where do we start this move up from right up here, and it went to here, and this is a pretty fast and furious move to the downside.
Right.
We broke through this trend line, should stay here. If this trend line was up here, then the market may not get so exhausted to the downside so quickly. It may have continued to move down, but it had already done a pretty good move to the downside. Not to mention what happened here. What happened here? We were going down, and it looked like we took out the lows here, and we were on our way down to our low. And what do? We reversed and moved all the way to the upside. So you got burned once here on what was thought to be a move back down here, and the market reversed itself there. So you're kind of cautious, and the choppiness of the market kind of puts you on edge, and it's distrusting. I like to say the market was distrusting. So when the market moved back above here, it's a problem. So the algos, yeah, they know where the stops are, but at some point they're going to come in, and if it reverses back above, then you're out. The other thing, we as retail traders don't know where all this stuff is going on. And so what I like to, so we have to figure out a proxy. We have to figure out a proxy for market sentiment. If all this is algo selling and they're selling, waiting to sucker some poor retail traders in, we can't just sit there and take it, okay? We have to do something about it. And we have to measure and try to find out a proxy that is going to tell us that that the sellers here aren't really all that interested in taking this market down. They're just playing with us, right?
Okay.
They played with us here. They played with us here. Are they playing with us here? And so I have two things. One, we broke through the trend line. We should go lower. We should get below this level. Up, we're not below that level. And the other thing that I'll do is I'll start to use Fibonacci retracements, and I'll look at the trend leg to the downside, and I'll start to measure the corrections back to the upside.
So the fibs are one of your proxies? Okay.
Right. Those come, because trends are one thing, and we know that trends, move in a directional thing. But then we have these moves back to the upside, these corrections, and if the corrections, for me, I call this the correction zone right here, the 38.2 to 50%. Ignore all this other stuff out here, but we're looking at this move to the downside right here, and then we see the correction come up, and I want to see if the sellers are so intent on selling the market through here, Dale, and listeners out there, don't you think they would be interested in selling at 38.2% off?
Right.
Don't you think they'd be interested in selling at 50% off? Taking it back to real life, if you love a good at a store, aren't you interested in buying that at 40% off?
Great one.
Aren't you interested in buying that at 50% off?
We're all looking for sales.
Right. And I, the only reason why Macy's and our favorite stores don't use a 38.2% off sale, which they use a 40% off sale, is because they would seem silly. But we as traders use a 38.2%. It's not ironic. I don't consider it a fluke that they use 40% off, because it's near the 38.2% off. And traders are the same way. If the market moves in a trending direction, it comes back to the 38.2% off, they're like, this is my opportunity to get in, to get the euro short, to sell the euro at a level. And as long as it stays below the 38.2 to 50% off sale, then everything's okay. If it moves above the 50%, I start to lose interest. I start to think that store is starting to that those sellers, their heart wasn't in it. In other words, it's a proxy for the algo traders, those guys who are out there, screwing with us a little bit. So the trade here is like getting, using the 100-bar moving average as your resistance level, you may not be here, and you may not, but when you start to see the 100-bar holding here, so you sell here, the market goes down. Okay, we're good. I feel no pain. I'm managing my trade. What's our next target? Get below this trend line. Okay, we get below the trend line. Good. We're zipping along. What's our next target here? All right. And either you're getting out here, or you're waiting around and you're watching the 38.2 and 50% off, and this is your line in the sand where you say, all right, I've had enough of this, and get out. So the market goes up to the 100, it stalls there, it comes back down to the 50, and where do we see the buyers? They're like, I better get out, and then they take the market back up here. Okay. That's the way I look at it. It's we as traders have to use proxies, but one of my proxies, I want to get into the mind of traders, and that's why I try to equate things to, if you're intent on selling the market fast and furious to the downside, you should be intent on selling it when it comes out 38.2 or 50% off. And if you're not, then I'm losing interest at that point right there. So that, again, defines my risk, limits my risk. I'm looking for the trend. If it doesn't trend, then I'm getting, you get out.
You should get out. I saw an interesting tweet by you. I'm looking for the euro to test that line. The tweet was U.S. dollar yen. Deja vu made me think of Crosby, Stills, and Nash. All right, so what's the deja vu? It's had a tremendous day. It took out the 61.8 level by a bit. Still deja vu, or 2013 beginning again?
Well, here's when I wrote that post this morning, deja vu again, and again, I'm just looking at the trend line. I'm looking at what happened yesterday. I'm looking down here. This is parallel trend line. Markets like to stay in little channels here. So if you just drew a trend line right here, and just at this point right here when the market started to come down, you just put a parallel trend line down here, and lo and behold, traders came in at that low. It's right on that borderline level. Risk can be defined, risk can be limited against that level. And the market moves back up, and it provides that candle. Next thing you know, support buyers. But my deja vu was here. We saw that little break above the trend line here, and what did it do? It failed Dale, and it's closed down here again. Another one of these candle formations that brings a big warning in. And what does the market do? It goes back down.
Yeah, so it's like your earlier example of having that range at resistance up there. You made money selling it there 3-4 times, 5 times. You tried it today. You got buried.
So my deja vu here was, fool me once, shame on you. Fool me twice, shame on me. And so it was like, is it going to be like yesterday? I'm skeptical about this market. It's been chopping around here, but what is my bias here? My bias is still bullish here. We're above the line, so the bias is bullish here. We're above the line here. We try to go below the 200-hour moving average. And look at this bar. This is the biggest bar of the day. So we're getting momentum here, and we move above that line right there. So the question, the deja vu was, okay, we're above that line. I'm bullish, but don't go back below this high right here in the Asian session, or don't go back below this 100-bar moving average, because at that point, I'm concerned more about the risk. I don't care about the reward. I don't want to get burned by having too much. So I'm just warning, that we could have what we saw here, and so I want to see the price remain above this trend line. And if you zoom in and look, is that it? No.
Yeah, there you go.
If you look here, what does this bar do here? This is an hourly bar. What does this bar do? We find support against the underside of that trend line right there. So it takes a little while to get going, but if you can't go below that line, what are the shorts going to do? They're gonna or the algo's going to do. They're gonna rip someone's head off here. They
wanted the stops over where everyone was selling it.
Right, yeah, and they want to get the people thinking like, well, it's Friday, and what I wrote about was like, okay, don't go below that level, and don't go below the high price from the Asian session. You can put your risk down to there, or you can also look at the 5 minute. What is it looking at here? So here's the move. Anyway, this level comes in at what level? At the 30 level. So here's the 30 level here. We come up to the 30, we come down, we get above that level, and I was like, I'm testing the market. Don't go below the 30 level, or don't go below these highs, or go below this low, or you can put a Fibonacci on this as well. You can go from here to here and say, don't go below 38.2, which is also equates to this high right here. That's what I did. Is that I said my risk is down to this 38.2 or this 50%. If it goes down below this level right here, we're going below the Asian high. We're going below this low right here, and so you can go above this 30 level, but don't take me down below this level. That's my risk. I don't want to see the price move below that level, and as long as it stays above here, we're okay. And going back to the hourly chart, and it does, and the rewards just happen. No one can predict that this is going to happen or this, and is there any reason why the dollar yen went rip and roaring to the upside? They'll write about it in the paper tomorrow. They'll say that it was the Dow going up, and they'll say that it was the Japanese tax thing and all that other stuff. Yeah. But we know April 1st is coming. We've known it's coming for a long time. So they'll write the story to fit the print. But we as traders have to trade the prints out here and define our risk and limit our risk and be focused on the risk. And if we're wrong, we're wrong. The market didn't. It was deja vu. It did the same thing that it did yesterday, and the market moved back down, and it's Groundhog Day, and we're going to go back down. And sorry, but that's the way it is. But if it doesn't do that, you have the chance to go to the bathroom and come back, and wow. Are we really at 72? And take advantage of that. And I said that the targets would be here, 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 and here, and those are the obvious targets. I said that we have successive lows here, so getting above those highs is what we need to do, and that's what the market did.
The bears are gone now. They'll start pounding the 108 yen, 110 yen scenario now. I'm pretty sure, but.
Well, they can do that for me. For me, that means nothing to me. The next thing is to get through this line, Dale. If we're going to get to 108, we got to get through this line here first.
Where's that come in? 103.30.
103.16 right now.
All right, so a pretty good line in the sand for long-term bears too.
There you go. Yeah. That's a borderline, the line in the sand. That's So if you want to sell, you can. If you're a bear, you want to sell. This is where you want to sell against. Right. And if it goes above that level, watch out. Though, because the other thing here that we've done here, speaking of non-trending, goes into trending, is that look at the 100-day moving average. Now, typically the market moves away from the 100-day moving average. Here we had 3 times where the market moved below the 100-day moving average, but no closes below it. We couldn't get a close below it. Right. Here we've had 7 of the last 8 trading days with the market moving, trading above and below the 100-day moving average. That's okay with me. What does that say to me? By the third day, I'm saying, this is not doing what it usually does. This means that the market doesn't know which way it wants to go.
Yeah.
If you can't move away from the 100-day moving average, the market is confused of which way it wants to go. Do we go lower or do we go higher?
It's neutral.
Right, yeah. So don't try to read into which way it's going to go or whatever. Just listen to what the market is saying. The market's saying, I don't know. And so you start to dig in, and the longer it stays around these levels, great. Yesterday, what did the market do? We didn't touch the 100-day moving average. We stayed below it, and so it actually gave you a bearish signal, and we moved down to new lows here. But the market, and that was this move here. And where do we come to? We came right to this line right here, and the market moved higher. And so it's still, even though we didn't touch the 100-day moving average yesterday, we came down to a support level that I had there, and we moved back above the 200, and then we sort of consolidated, and the market was coiling like a spring. And then the spring popped right here. The spring popped above the 100-hour moving average, moved above the trend line. We did this yesterday. That's the deja vu, so you got to be careful. But risk is defined and risk is limited, and then the market moved to the upside. So non-trending transitions into trending. So the 108 people or the 105 people or whatever, they may be right in the long run. And quite frankly, we should go higher. We should go higher from here. I'm not giving any buy, sell, or hold
Right.
recommendations
Right.
here, but just from my educational standpoint right here, we're breaking away, and we're going to have a close above or we should have a close above the 100-day moving average, and that should set us up for next week. And what we do know is that longer term, we should not go back below the 100-day moving average, right? Wouldn't you agree? I mean, we traded 7 out of 8 days above and below it. Now we're breaking away. We tried the downside, it failed, and that again, the failure. Okay,
Right.
but we came down to key support there, and we and the market moved away. We should not go below the 100-day moving average. We just should not go below.
Yeah,
We should
so
move away
previous
from it.
highs about 102.50. If we start trading back under 102.50, this again was. And I have a belief, Greg, and I will wrap it, that big money, if they want to get short, will engineer a rally to distribute, and if they're bullish, they'll engineer a decline to accumulate. So
Right, and, but we as retail traders cannot engineer those
No, we
moves.
can't.
We are just the fly on the back of it. But we have to recognize the failures, and if they want to engineer a move to the upside to sell, and they want to sell right here against this level or just above it and fail it, or go down here and fail. We just have to be aware. We have to try to be in their brain and use proxies, use the technicals. That's why technicals are so important. So because they tell us what the market is thinking. They can hide, and they could do things secretly and things that we don't see. But if we're doing our homework, if you're doing your homework out there and you utilize the right tools that provide action, and have the right mindset about what these tools mean and what failures mean, and just kind of use that to convince yourself and to be confident in what you're doing, and recognize that you're going to lose. But if you can get in their minds and use these proxies, these Fibonacci retracements and moving averages and stuff, and see between see what they're doing that way. That's the only way that retail traders are going to survive. It's not going to be, you're not going to move the market. You're just going to be the follower, and we got to thank them for moving the market. To be honest
Yeah.
with you, if they weren't around, we wouldn't be able to move the market. So they have to move the market. So they are the
work for
ones.
us.
That's right.
Don't be afraid of those algos or any other central bank, Fed head, or anyone. They work for us. They set us up with good entries.
Thank them, and then follow the trends, by targeting levels along the way. And if you catch a trend, you're sitting on top of the world.
Where's your bottom line come in, where they kind of converge? No, the next one down, all the way at the bottom.
Right
Down there,
down
yeah.
here.
98.5, 99.
I'm looking at where those levels come in. Yeah, they come in around the 98.67 level. This 50% retracement. This is the longer term move here. This is my my big line
I
here.
see it.
I'm big on the 50% retracement. So that if we move back below the 99.84.5, then all bets are off for dollar yen going higher in 2014.
Interesting level.
Yeah. So
I
the market moved above and below it here, admittedly, but when we move back above it here, it's just another borderline level. But I'm key on 50%. I love 50%. It's the midpoint.
Well, I'll tell you what, this conversation, Greg, and this interview was 100% education for our community, and I really appreciate you talking to us. It's really a pleasure knowing you now. I'm grateful that I have this position where I get to talk to contemporaries like you and encourage people to follow you and pick up Greg's book, buy his book, and use the promo code. And look forward to further conversations with you, buddy.
Well, thank you for you. Thank you as well. Anytime I'm available. I love this. I mean, it was great, and I really appreciate just shooting the breeze with you, and you did a great job in leading me
It
along
was
the
a
way.
great
Thanks.
interview, Greg. Really, respect to you. So
Same to you, my
thank you,
friend.
buddy. Have a great weekend. Good hunting, and
You
let's
too.
get
You
in
too.
touch soon.
All right.
All
Take
right,
care. Bye bye
Greg.
now.